Once again, I'm starting with the dollar. And one reason for this is some intriguing predictions I spotted on ABC's The Business program last Wednesday. The Business asked several of Australia's leading money experts to go on the record about the Aussie dollar. Specifically, they were asked to nominate where it would be against the American dollar at the end of this year.
Our forecasts have the Aussie at parity with the US dollar at the end of 2012. Now, the Aussie dollar's performance has been one of the big surprises the last year or so. It's been amazingly resilient given the global backdrop. In fact, if I just flown in from Mars and you told me the global story and asked for a currency forecast, I probably would have said about 70 cents. Now, the Aussie's not immune to what is going on. We think it will drift from around 107 today down towards that parity level at the end of 2012.
I think it'll be around 90 cents. The key driver of the currency is really global growth in commodity prices. There are some other things that play a role, but that's the big picture thing that drives it. And I think we're going to see slower global growth, commodity prices come off. So I think the risks are the currency goes down, not up this year.
I'm picking at $1.07, just above parity. I think it's principally a story of the power proximity because China and India, Indonesia are demanding Australia's resources, and for that reason I think the dollar will be strong, and the rest of our fundamentals are closely tied to the emerging markets where, again, that's where most of global growth is going to come from.
Well, we think the Australian dollar, where commodity prices are currently around, will be good value at around about 101. So we have the Australian dollar by the end of the year around parity. I think it'll bounce up and down a bit in terms of weakness in essentially the US dollar because of quantitative easing being offset a little bit by further falls in commodity prices as we go forward.
We're looking for the Australian dollar to be around 1.05 against the US dollar at the end of the year. In the near term, with the RBA lowering the cash rate and some more weakness coming through in the global economy, we do think the Australian dollar could lose some of its recent strength, maybe even head down towards parity again. But again, over the course of the year, with the global economy stabilising, looking a little bit better, and the Australian economy looking a little bit better, we do expect the strong fundamentals of China growth, demand for AAA rated debt, which Australia has, is all going to help the Australian dollar remain reasonably high.
So from 90 cents to $1.07, a substantial difference of opinion. And here's what that difference means to Australian farmers. If our dollar is 90 cents American and an Aussie farmer sells, say, $10,000 worth of wheat through the Chicago Board of Trade, that's 10,000 American, of course, because the vast bulk of international trade is done in the American currency. Here's the return to our Aussie farmer at 90 cents, 11,111 Australian dollars. I hope my third form maths is correct. And here's the return of the Aussie dollar is the equal to the current exchange rate. As I speak, it's well above $1.07. The difference is quite a bit, isn't it? More than $1,800. Let's get to the prices now. And the big hit last week was wool. In a move which surprised market watchers, buyers from China hit the accelerator and pushed indicators up across all merino types and micron ranges. And this was against a background where the exchange rate actually bumped above $1.08 for a few hours. Buyers from Europe and India were forced to respond, and the crucial Eastern market indicator finished up 4.4% for the week. Some reports suggested it's a looming supply problem, while others said it was as simple as meeting shipping deadlines. So the EMI closed at 1,243 cents a kilo, a rise of 50 cents for the week, with some 16.2 micron wool fetching above 1,700 cents a kilo. Interestingly, there are some reports circulating that the market for ultrafine wool, and from memory that's wool 14.5 microns and below, it's on the verge of collapsing. Some more on that hopefully next week. Let's stay with livestock, and available cattle numbers have been severely impacted by wet weather in the east. Flood damage is causing weight restrictions on several roads, and of course mustering in many paddocks right across the country has been all but impossible. In the longer term, of course, grazing conditions will be excellent. So prices were mixed, and it should be noted several prime sales were actually cancelled. The car market is perhaps surprisingly firm. Most exporters, though, would be doing it very, very tough. And the sale yard action last week left the Eastern Young Cattle Indicator at $3.93 a kg, which is exactly the level it was in this week of last year. The live trade, though, has the jitters. Permits are going fast, and although rumours in the north about more permits are as common as big hats, there's nothing to indicate when or actually if this might actually happen. So sellers have been anxious, and at the moment it's a roll gold buyer's market. 3 ships left Darwin last week. Both steers and heifers fell 5 cents a kg, and unless the permits arrive, expect more downside. The sheep market is at a bit of a crossroad too. Dry and hot weather in the south has tempered restock enthusiasm, while a strong dollar is putting a lid on exports. And add to this, numbers offered last week were way up, and that includes South and Western Australia. So the lamb indicator crashed 28 cents. That's the biggest weekly fall I can recall. And sheep also fell out of bed, dropping 24 cents. Checking grains now, and futures trading has the stumbles both here and abroad. In Chicago, the bulls ran for cover in wheat and corn, while soybeans had a bit of a lift. American wheat exports are said to be strong, but world supply is said to be at or about an all-time high. Here in Australia, futures trading is pretty active too, with the market reacting to Chicago, and prices are off a fraction. New South Wales wheat shed more than $2, while wheat out of the west dumped $6. Now, keen market watchers will realise these prices are more than 50% below the futures prices on offer last February. But it's the spot prices which really tell the story. Here's the comparison for wheat, canola and sorghum this year and last year. Canola has shed $105, while sorghum has dropped a mere $62. And check wheat. Wheat since February 2011 has crashed $132 a tonne. To New York now for the soft commodities, and cotton is the intriguing story here. The price is actually slipping, but there's a lot of bullish comment around with market chatter about a huge disease problem in the Indian cotton crop and insatiable demand for cotton from China. But cotton slipped more than 3 cents last week. Sugar picked up what it lost the week before, and it appears to be stuck around that 24 cents level. This week last year, it was actually above 32 cents. Next week, I'll check on flood damage to farming and grazing country in the east, what the wet has done to various crops. It's been tough for many, but as any farmer will tell you, you can't make money out of dust. And that's the Landline check on prices.